Every time I review Michael Burry's portfolio, it seems like he's flipping the tables on Wall Street. Last quarter, he went full doomsday, loading up on bearish bets and essentially shorting the market. But this quarter, he's flipped again. And not just a little, the change is dramatic. I know. Burry has made his reputation by making bold, contrarian moves that leave everyone questioning what he sees that others don't. His latest 13F filing shows a sharp shift from defense to offense, moving away from portfolio that looked prepared for disaster to one that suddenly looks surprisingly optimistic. It's a complete pivot that once again proves that following Burry is never boring. In this video, I'll break down exactly what changed and what his latest moves might tell us about the market ahead. I'll also dive into 3 of his top 4 holdings, which I believe could have the potential to deliver market-beating returns. So stick around because this shift might reshape how you think about investing right now. Now, before we jump into Burry's portfolio, I'd like to say sorry to my followers for uploading less videos over the last month. I am planning to go back to my normal schedule going forward. So if you like these kind of deep dives, consider supporting my channel by dropping a like and subscribing. Thank you, and on to the portfolio. So Michael Burry's holdings this quarter are almost unrecognizable compared to the last one. Instead of loading up on bearish put options, he shifted sharply to bullish bets, with most of his positions now made up of calls, which benefit if a stock goes up. So let's break it down. Starting at the bottom, we have Mercado Libre, the Latin American e-commerce giant, making up about 1.4% of the portfolio. This one is a straightforward long position, meaning Burry owns the shares directly. Next is Bruker Corp, a scientific instrument company at 1.8%. This is another traditional long holding. Then we move into a string of bullish call option plays. VF Corporation, best known for its apparel brands, comes in at 3.1%. At 3.5%, we see ASML, the European semiconductor powerhouse, also through call options. Alibaba, one of China's largest e-commerce players, represents 4.9% of the portfolio, again via calls. Slightly larger is JD.com, another Chinese online retail giant, at 5.6% through call options as well. His 5th largest position is Estée Lauder, the global beauty brand, which makes up 9.1%. Interestingly, this one is split between calls and direct long positions. Then we step into the biggest bets. Meta Platforms comes in at 12.8%, all in call options. Lululemon, the athletic apparel leader, takes the number 3 spot at 18.5%, and it also has a combination of calls and direct shares. In second place, Regeneron Pharmaceuticals, a major biotech firm holding 19.5% of the portfolio, again both in calls and stock. And finally, his single largest position this quarter is United Health Group. This healthcare insurance giant makes up nearly 20% of the portfolio, with a mix of calls and traditional long stake. So to sum it up, this quarter's portfolio is a complete reversal from last time. Burry has gone from shorting the market to loading up on bullish bets, especially in healthcare, consumer brands, and global tech. The headline this quarter is how drastically Burry has shifted gears. In Q1, he was almost entirely bearish, betting against tech and Chinese stocks. And now his portfolio is stacked with long bets, which is a clear sign he no longer sees imminent doom. Also, United Health and Regeneron now make up over a third of his portfolio, making healthcare the dominant theme. It's a mix of steady defensive growth and cutting-edge innovation, a combination that can hold up even in a choppy market. Additionally, after betting against high flyers like Nvidia last quarter, Burry is now bullish on names like Meta and ASML, which is a total reversal that shows how quickly he'll pivot when valuations or sentiment shift. His sizable positions in Lululemon and VF Corp signal confidence that shoppers will keep spending even on premium goods. And that's a bold stance given the uncertain economic backdrop. Finally, in Q1, he was shorting Alibaba and JD.com. And this quarter, he has flipped into calls and raised his exposure, suggesting he sees real upside at today's valuations. So overall, Burry's portfolio this quarter is a complete transformation, flipping from bearish to bullish with big bets in healthcare, consumer brands, and tech. But the key question is, are these stocks undervalued today? Or is Burry simply making another contrarian swing? To find out, let's take a closer look at 3 of his top 4 holdings and run the numbers from a value investing perspective. We'll calculate their intrinsic value and see whether they might be trading below fair value right now. Since I recently uploaded a full video on United Health and I do think it's undervalued, I will not be covering it again here. If you're curious, I've linked that video in the description down below. Instead, we'll focus on the next 3: Regeneron Pharmaceuticals, Lululemon, and Meta Platforms. Starting with Meta Platforms, which is currently trading at around $737, and as you can see, it has been on a tear since November 2022, as it went up more than 7 times in just 3 years. They're currently trading at around 27 price-to-earnings ratio with a forward PE of 26. They also have this great return on invested capital of over 30%, and on top of that, they have only $2.5 billion in debt, which is virtually nothing, as the company is currently trading at close to $2 trillion. Looking at the revenue, they have a stable growth, growing from $27 billion in 2016 to around $164 billion last year, which is around 6 times in just 10 years. During the same time, net income showed some dips. However, it still grew from $10 billion to $62 billion, also a 6-time increase in just 10 years. On top of that, they have been steadily buying back shares, going from $2.9 billion to $2.6, essentially increasing shareholder value by 10% along the way. And it seems like analysts predict Meta's revenue to continue on growing, going from $164 billion to basically $323, pretty much doubling in the next 5 years. As for earnings per share, they see a similar picture, going from close to $24 to around $45 in the next 5 years, pretty much doubling as well. Now, let's do an intrinsic value calculation. In the last 12 months, Meta did $27.56 in EPS. And according to analysts, their EPS will almost double in the next 5 years, which is around 15% return. So let's give them 15% growth rate over the next 5 years. And let's say for the 5 years after that, they will slow down and only grow at 10%. Now, in my opinion, this growth is fairly high, and on top of that, Meta is a moat, so they do deserve a higher multiple. So let's give them a 20. And as you can see, for a 10% annualized return, you could pay $955 today, when Meta is actually trading at around $737. I have just adjusted my assumptions, and it seems like if these numbers come true, Meta could return closer to 13% annualized returns over the next decade, even if I lower their earnings per share growth to 14% for the first 5 years. Meta still looks pretty much fairly valued to deliver the 13% annualized return. So Meta is in a strong financial state with virtually no debt and a strong return on invested capital. And while the stock is trading at a fairly high multiple, that valuation might be justified by its strong growth prospects. They're also aggressively buying back shares, which further supports shareholder returns. Altogether, Meta looks like it's positioned to deliver solid performance, with a potential of around 13% annualized returns over the next decade. Now, on to Lululemon. Lululemon is currently trading at close to $200, which is far off its all-time high of almost $500 that it reached in 2023. They have a fairly low price-to-earnings ratio of around 13.5, with their forward PE pretty much staying the same. And surprisingly, for an apparel company, they have a really high return on invested capital of over 40%. On top of that, they have pretty much no debt, as their net debt to EBITDA ratio is 0.1, and we like to see it under 2.5. Looking at their revenue, they have this beautiful steady growth over the last 10 years, going from $2 billion to around 10. And net income shows a similar picture, going from $266 million to to 1.8 billion, which is around 6 times. On top of that, the company has been increasing shareholder value, buying back shares almost every year over the last 10 years. And it seems like analysts predict their revenue to continue on growing steadily over the next 5 years at around 10%. And when it comes to earnings per share, they see a similar 10% growth over the next 5 years. So with all of these numbers, let's go to the intrinsic value calculator to figure out if a company could be undervalued today. Over the last 12 months, Lululemon did $14.70 in EPS. And according to analysts, their EPS should grow at around 10% over the next 5 years. So let's keep this growth rate at 10. And let's say that their growth will slow down and Lululemon will only grow at 5% for the 5 years after that. In my opinion, a 15 terminal multiple is fair for a company like Lululemon, so let's keep it there. And as you can see, according to these assumptions, for a 10% annualized return, you could pay $303 for Lululemon today, when it's trading at around $200. I've just adjusted the numbers, and it seems like with these assumptions, Lululemon could actually return closer to 16% annualized returns over the next decade. So overall, Lululemon looks like a very well-run business financially. The company consistently returns a high return on invested capital, carries little debt, and has shown stable growth over the years. On top of that, management has been steadily buying back shares, increasing long-term investor value along the way. And when you put it all together, the numbers suggest that Lululemon could realistically deliver mid-double-digit returns over the next decade. Finally, let's look at Regeneron. So Regeneron Pharmaceuticals is currently trading at $563. And in just last year, their stock price is down more than 50%. They're trading at a 14 PE ratio, which is fairly average, and have a forward PE ratio of also 14. They have a decent 12% return on invested capital, and they're trading at $58 billion in market cap. However, their enterprise value is $43 billion, which basically means that the company has pretty much $15 billion of cash on hand. And it's truly difficult to go bankrupt when you have a quarter of your market cap in cash. Now, looking at their revenue growth, they have been growing from $4.7 billion to $13.6 in the last 10 years, pretty much tripling. There was this huge spike in 2021, followed by a dip in 2022, but since then the company seems to have stabilized and is growing consistently. Looking at their net income, we see a similar picture with the spike in 2021, but overall it seems like the company went from $900 million to $4.4 billion in just 10 years, growing pretty much 4.5 times. As far as shares outstanding go, they have been pretty much stable over the last 10 years. Not buying back, not issuing, which is okay. Now, as far as analyst predictions go, we're expecting Regeneron's revenue to grow fairly steadily over the next 5 years, going up to around $18.2 billion. And as far as earnings per share go, analysts predict the similar close to 10% annualized growth over the next 5 years. So keeping that in mind, let's calculate Regeneron's intrinsic value. Over the last 12 months, Regeneron Pharmaceuticals did $39.74 in EPS. And according to analysts, their EPS should grow at close to 10% over the next 5 years. So let's give them an 8. And let's say they will slow down and only grow at 5% for the 5 years after that. In my opinion, the terminal multiple of 15 is fair, and with these assumptions for a 10% annualized return over the next decade, you could pay $756 for the company today, while the company is actually trading at $563, signaling that Regeneron might be undervalued. I've adjusted the numbers, and it seems like Regeneron could actually return closer to 14% annualized returns over the next decade. Now, keep in mind, all of these numbers do not include the fact that Regeneron has around $15 billion in cash, which is basically a quarter of their market cap. If we would deduct that money from their stock price, Regeneron could actually return closer to 20% annualized return over the next decade. So Regeneron stands out as a solid company with zero debt on its balance sheet. While the business did face a dip in revenue in 2022, it has since stabilized and is showing renewed growth. And looking ahead, the numbers suggest that it has the potential to deliver strong market-beating returns of 16% annually over the next decade. So to sum everything up, looking at Michael Burry's portfolio this quarter, the shift from bearish to bullish is nothing short but dramatic. He has gone from betting on market downturns to loading up on companies with strong fundamentals and growth potential. Across healthcare, consumer brands, and technology, Burry's bets suggest confidence in both stability and long-term upside. And our deep dive into his top holdings shows why. Regeneron, Lululemon, and Meta Platforms seem to be all positioned to deliver market-beating returns over the next decade. And taken together, these positions highlight Burry's preference for high-quality businesses with durable competitive advantages. And while his portfolio changes are bold and drastic, the underlying companies suggest a thoughtful strategy, investing in strong, well-managed companies that have the potential to deliver great returns. Now, if you're still curious about United Health and two other healthcare insurance businesses that I have recently bought, you should be able to see the two videos somewhere on the screen or in the description down below. Now, if you enjoyed the video, consider subscribing and clicking the like button. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.